Did you know that the Bank of Canada has cut its overnight lending rate by an impressive 225 basis points over the past year, more than any other developed country's central bank except for New Zealand? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. The Bank of Canada has decided to hold its overnight lending rate steady at 2.75%, a decision that has left some property professionals looking for further cuts to energize the country's real estate market. According to CoStar News, the bank had paused rate cuts for the first time in a year back in April, and has already reduced its rate significantly over the past year. However, many in the industry believe that more reductions are needed to boost consumer confidence and stimulate the market. Christopher Wine, the Chief Operating Officer of Burlington, Ontario-based multifamily company Equiton, expressed disappointment in the decision, suggesting that even a small quarter-point cut could have helped build confidence among consumers. Canadian consumer confidence is said to be at a 10-year low, impacting pre-construction home purchases and freezing the housing market. The move comes amid global trade tensions, particularly with the United States, where President Donald Trump's threat to raise tariffs on Canadian steel and aluminum could further strain the economy. The Bank of Canada is closely monitoring these developments, along with recent inflation data, as they decide on future rate adjustments. Despite the current hold, money markets and economists are predicting at least 2 more rate cuts by the end of the year. Marcus and Millichap pointed out that further cuts could lower borrowing costs for those with variable rate mortgages and benefit developers who rely on short-term financing. However, they also cautioned that rising bond yields could offset some of these advantages. The Toronto Regional Real Estate Board reported a 4% decrease in average sales prices in May compared to last year, with sales dropping by over 13%. This indicates a cautious market, as potential buyers remain wary amid economic uncertainty. Royal LePage's CEO, Phil Soper, emphasized the importance of the Bank of Canada's upcoming rate announcements in maintaining stability and controlling inflation. Jordan Kemp, Vice President of Development at Greywood Developments, highlighted that while a rate cut could have been beneficial, the broader economic uncertainties mean it may not have a significant impact in the short term. Developers and purchasers are navigating a complex landscape influenced by fears of recession and other global factors. Cap rates are often regarded as the most famous yet misunderstood number in commercial real estate. A capitalization rate, or cap rate, is a simple formula: net operating income, NOI, divided by the purchase price. It represents the annual return an investor would earn on an all-cash purchase, excluding financing costs. However, while the calculation is straightforward, the implications are anything but. According to Volodya Gusak, president of Density Development, cap rates measure operational performance but do not capture the full story behind an investment. One of the primary rules when considering cap rates is to never rely solely on them without context. They do not account for factors such as location, tenant credit, lease terms, building condition, or whether the NOI is stabilized or in place. This can lead to significant misunderstandings, as exemplified by a past transaction involving a shopping center sold at a 6% cap rate, which appeared favorable until the buyer discovered a leaking roof requiring millions in repairs. The cap rate didn't reveal these issues, highlighting the need for comprehensive due diligence. It's crucial to use cap rates only on stabilized income. Stabilized NOI reflects a property's long-term, sustainable performance based on market rents, typical expenses, and normalized vacancy. In contrast, in-place NOI is a current snapshot that might not accurately represent future performance. For instance, a retail center with a national tenant whose lease is about to expire might present a misleading cap rate if the renewal terms are uncertain, potentially affecting the property's value drastically. Cap rates are also considered risk-adjusted returns. They represent the premium investors demand above the risk-free rate, such as the Government of Canada 10-year bond yield. For example, a grocery-anchored retail property in a metropolitan area might have a cap rate spread of 2 to 2.75% above the bond yield, reflecting its relative stability and risk profile. This risk adjustment is vital when comparing different asset types and understanding the underlying market conditions. Another important aspect is to not take cap rates at face value without verification. Each asset is unique, and factors like vacancies, potential repairs, and repositioning efforts can significantly alter an investment's attractiveness. Investors should be wary of listings that offer pro forma stabilized NOI based on overly optimistic scenarios. It's essential to rebuild the numbers independently to ensure accuracy. Finally, while cap rates provide a snapshot of potential returns, they must be understood in the context of a broader narrative. Real estate investments offer advantages beyond bond yields, such as inflation hedges, tax efficiencies, and value creation opportunities. However, they also require active management and come with liquidity risks. Investors need to weigh these factors against their risk tolerance and investment goals to determine if they can truly sleep at night with their investment decisions. In a notable development from south of the border, the University of Denver is making headlines with its decision to sell a significant parcel of land near its campus for multifamily development. This move is set to transform a busy corner into a vibrant hub, potentially allowing for the construction of buildings up to 7 stories in height. The Denver Business Journal reported on November 4th, 2025, that this site is primed for infill development, which could cater to the growing demand for housing in the area. The University of Denver's strategic decision to sell this land reflects a broader trend in urban areas, where educational institutions are leveraging their real estate assets to support regional growth and meet housing needs. By opening up this site for multifamily development, the university is not only addressing local housing shortages, but also enhancing the appeal of the neighborhood, likely benefiting local businesses and the university community alike. This development is an exciting example of how institutions can play a key role in urban renewal and economic stimulation. With the potential for significant residential capacity, this project could attract a diverse mix of residents, including students, faculty, and young professionals, adding vibrancy to the area. It's an inspiring model for other universities and cities to consider, particularly in regions experiencing similar growth pressures. As we continue to monitor similar opportunities in Canada, particularly in Ontario's bustling urban centers like Hamilton, Kitchener-Waterloo, and London, it's important to recognize the potential for educational institutions to contribute to multifamily real estate development. Whether through direct development or strategic sales, these efforts can significantly impact housing availability and community development. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.